Did you know you've probably used one of this company's products this week without even realizing it? Welcome to the EDGAR Brief. Today, we're cracking open the Q1 2026 10Q from RTX Corporation, translating all that dense Wall Street accounting into plain English. Quick note right up front, we are independent, not SEC affiliated, and definitely not financial advisors. We use AI to help summarize these massive filings so errors can happen. Always verify on sec.gov before making any actual money decisions. All right, let's get into it. Take a look at this number, $22.1 billion. That is the actual cash revenue that literally walked through RTX's doors in just 3 months, one single quarter. Now, you might not know the name RTX off the top of your head, but if you've flown on a commercial plane or even just skimmed global defense news this week, you've absolutely seen their products in action. So here's our roadmap for today's explainer. We're going to decode the business model, run through the Q1 scorecard, check their economic moat, read between the lines of management's commentary, highlight the real red flags, and finally, give you the bottom line. Starting us off, decoding the business model. To really wrap your head around RTX, think of it as a massive engine, fueled by 3 very distinct tanks. So what do they actually sell and to who? Basically, they sell heavy-duty aerospace and defense systems, everything from commercial jet engines to military missiles, to airlines, aircraft manufacturers, and governments worldwide. In Q1, before any internal accounting transfers, Pratt Whitney was their biggest fuel tank at $8.17 billion. They're the ones building the aircraft engines. Then you've got Collins Aerospace, bringing in $7.6 billion, making all the internal flight systems and avionics. And finally, Raytheon at $6.95 billion, handling the heavy defense systems like missiles and radars. All this money comes in, but a huge chunk goes right back out to fund massive payrolls, gigantic factories, and nonstop R&D. But here is the real secret sauce of how they make their money. It's not just about selling a product once. The magic word here is aftermarket. Think of it exactly like a car dealership. Selling the actual airplane engine, that's just selling the car. And honestly, sometimes they sell it at a razor-thin margin. But the decades of mandatory servicing, replacement parts, and repairs at Pratt Whitney, that's the highly profitable mechanic shop. And trust me, that mechanic shop is the true cash engine of this entire operation. All right, let's move on to the Q1 scorecard. This is where we translate those incredibly dense accounting tables into numbers that actually show us the health of the business. Are they a tortoise, a hare, or a cash cow? First question we always ask, are more dollars walking in the door today than yesterday? The answer for RTX is a definitive yes. In Q1 of 2025, they saw $20.3 billion in net sales. Fast forward to Q1 2026, and that jumped to $22.1 billion. And the best part? That growth is organic. It means they're actually selling more core products and services, not just buying up other companies to artificially inflate the numbers. But revenue is vanity, right? What do they actually keep? Well, this 11.6% is their operating profit margin. So for every single dollar taken in, roughly 11.6 cents sticks around as pure profit from the actual business. And that's before they even touch taxes or financing tricks. This is actually up from 10% in the same quarter last year, which tells us this massive engine is running just a little bit more efficiently right now. We still have to run our lights out test though. Basically, if revenue completely stopped tomorrow, how long until the lights literally go out? Well, RTX is sitting on a very healthy cash pile of $6.8 billion in the bank. But, and it's a big but, that has to be weighed against a massive total debt load of $37.4 billion. That debt is some pretty heavy friction grinding in the gears of our machine. The good news here? Management isn't just ignoring that friction. The filing explicitly shows RTX is actively paying down their long-term debt. And by doing that, they actually drop their net interest expense down by $53 million compared to this exact time last year. That is real hard cash saved that can go right back into the business or out to the shareholders. Next up, checking the economic moat. So what exactly stops a hungry competitor from crushing RTX tomorrow? Well, an economic moat is pretty much what it sounds like. It's the thick, armored casing that protects the RTX machine from outside attacks. If a company doesn't have a moat, they're basically caught in a competitive knife fight, which is incredibly dangerous for their long-term survival. Fortunately for RTX, they are decidedly not in a knife fight. This filing silently bakes in some massive deep-water moats. First off, switching costs. If you're a major airline, the sheer pain and cost of swapping out an entire fleet's Pratt Whitney engines for competitors, it's immense. You are basically locked in. Second, their technological scale is so deep that upstarts simply can't match their pricing or their R&D budgets. And finally, they hold decades-long government defense contracts. You don't just walk into the Pentagon on a Tuesday and easily steal a Raytheon missile contract.
Moving on to reading between the lines. This is where we crack open the management's discussion and analysis, the MD&A. It's where we decode what the executives are emphasizing to see if the real numbers actually back up their story. Are they owning their results or just making excuses? I want to highlight this specific quote right out of the Raytheon segment's MD&A. They mention a favorable change in mix, primarily driven by increased production on Patriot programs. Translated from corporate speak, that means current global instability and demand for defense systems isn't just some news headline. It is directly translating into high margin profit for RTX. They're selling a lot more of the highly profitable stuff.
And over at Pratt Whitney, we see the true power of that mechanic shop analogy we talked about earlier. The filing notes that higher operational costs and international tariffs were actively eating into their profits on brand new engines. But their aftermarket volume, all that servicing and parts replacement, was so strong that it actually drove a $100 million organic operating profit increase. They totally flexed their pricing power on repairs to completely absorb the headwinds hitting their factory floors. Now that is an incredibly durable business model. Which brings us to red flags to watch. But hey, it's not all clear skies. Item 1A in these SEC filings is usually written by a team of corporate lawyers to cover absolutely everything, up to and including an asteroid strike. We need to filter out that boilerplate to find the company's actual vulnerabilities. So, looking at the left side here, you can totally ignore the standard filler about general economic downturns or severe weather. Every single company says that. The real company-specific risks explicitly flagged in this Q1 document are on the right. They are actively dealing with Department of Justice deferred prosecution agreements over past contract pricing and trade compliance issues. They've also got ongoing costs from a previous powder metal manufacturing defect. And they are explicitly warning about potential delivery delays tied directly to the conflict in the Middle East. These aren't just hypothetical future problems, folks. These specific headwinds are actively threatening the efficiency of their profit engine today. Rising operational costs and trade tariffs are already squeezing their margins on the new product side, which forces them to rely heavier and heavier on that aftermarket service revenue just to make up the difference.
And finally, the bottom line.
All right, let's bring this all together. We've looked at the fuel, the engine, the friction, and the armor. So here is the objective verdict based strictly on these Q1 numbers. RTX is a massive, cash-generating aerospace and defense machine. It is fiercely protected by a durable contract and switching cost moat. However, it's dragging around some seriously heavy debt friction that management is only slowly trying to chip away at. Bottom line, it's a total cash cow, but a heavily leveraged one. So when the next EDGAR filing drops in 3 months, here are the 3 concrete things you need to track. 1. Look for any escalating cost updates regarding that Pratt Whitney powder metal manufacturing issue. 2. Track their progress on paying down that $37.4 billion debt load. Are those interest expenses still shrinking? And 3. Check the MD&A for any severe supply chain impacts or delivery delays stemming from global geopolitical conflicts. I'll leave you with this final thought. With total debt sitting at roughly 35% of their total company funding, can RTX's highly profitable aftermarket cash flows actually weather a prolonged geopolitical storm if global supply chains freeze up? It is the absolute ultimate stress test for this machine. Well, that's your EDGAR brief on RTX. Remember, this explainer was a translation, not a recommendation. Go read the original filing on sec.gov if anything here piqued your interest. Thanks so much for being with us at the EDGAR brief, and we'll see you in the next filing.